couple people get in. We're climbing, crazy stuff. All right, so good morning, good afternoon, everyone, and welcome to today's webinar. My name is Kyle Kugler, and I'm the Iowa SourceLink Program Coordinator at the University of Northern Iowa's John Papajohn Entrepreneurial Center. In today's webinar, we have Kurt Connick, who will be covering individual income tax updates. Kurt is the Individual Income Tax Policy Director in the Research and Policy Division at the Iowa Department of Revenue. Whole lot of words there. Hope you enjoyed that one. So welcome, Kurt, and thank you for sharing this information with us today. Before we get started, I'd like to share a little bit about what we do at Iowa SourceLink and some information regarding today's webinar. So at Iowa SourceLink, we assist Iowa entrepreneurs who are looking to start, grow, fund, and even exit their businesses by providing step-by-step guides. We make helpful referrals and connections to our nearly 400 city, county, and statewide organizations who provide free business assistance. And we're also home to the Business License Information Center, which is a centralized database of all business licensing within the state of Iowa. All right, so let's go over some housekeeping items for the webinar today, and then we will go ahead and get the show started. Today's webinar is being recorded and will be available at a later date. Typically, what a later date means, within 24 to 48 hours from today, when the webinar concludes, it will be live either on our Iowa SourceLink website, or you can find us on YouTube by searching Iowa SourceLink or IA SourceLink. The slides you see today will be shared momentarily in the chat box by my colleague, Sophie Troxel. So thank you, Sophie, for that. Sophie and I will be sharing other resources and contact information if and when they get brought up during the presentation today, also inside of that chat box. As a disclaimer for you, Iowa SourceLink does not provide any sort of continuing education certificate for your attendance here today. We do, however, send out an email to all those who attend that can be used as proof of attendance for today. So that comes out between 24 to 48 hours after the webinar concludes. Again, we do not provide continuing education certification for your attendance here today, but you will receive an email stating that you did attend today, not a certificate for that. So lastly, please enter any questions that you have into the Q&A chat box located on the bottom half of your screen. We're going to hold off on answering the questions that come through until the very end. It's a very lengthy presentation today, so we might take a short break in the middle, just kind of depending on how many questions there are and just how things are going. If there isn't enough time to get through all of the questions today, don't worry, as all questions will be sent to Kurt alongside your contact information. All done, right? So with that, Kurt, I will let you take it away.
All right, Kyle, thanks.
Yep.
Thanks for that. Yeah, as Kyle mentioned, I'm Kurt Connick. I'm the Individual Income Tax Policy Director for the Iowa Department of Revenue. My contact information is on the screen. Just make note of if you have questions about the presentation today, or maybe even some of the administrative rules and stuff that we've posted, feel free to reach out to me. I'll be happy to try to answer any of the questions that you do have. Before we get started, I need to start off as usual with the disclaimer and just remind everybody that this presentation today is intended for general educational purposes only. Again, nothing should be construed as legal advice today, and it is possible that in the future the department could take a contrary position to one that I state today. I'm certainly going to give you the best information that I have. If you do want some guidance that is binding upon the Department of Revenue, you can request a petition for a declaratory order, and I've got the code section up on this screen for you. A couple things about the Department of Revenue. Our mission statement is for the Iowa Department of Revenue to serve Iowans and support state government by collecting all taxes required by law, but no more. And the vision is for Iowa to be a state where it's easy to understand and comply with the tax obligations for all Iowa tax filers. And Director Mosman, she does repeat this on a continual basis. She's on board with the Department of Revenue, just staying in their lane, just collecting the taxes that are due for the state of Iowa, and she certainly wants to make sure that it's easy for everybody to comply with their tax filing obligations. So I think we're going down the right path, but she's on board with this, and the department, the team members are continually reminded of the mission and the vision. here's an overview of what we're going to cover today. As Kyle mentioned, I blocked out 2 hours for today. There's a lot to cover. We're going to go through legislation from tax year 23. I've got some of the bills that I'm going to cover in a few minutes, and then we're going to jump back to tax year 22 and talk about some exclusions that all come into play in tax year 23. And then we're going to jump all the way back to 2018 with Senate File 2417 with some contingent changes that are no longer contingent, and they all come into play in 23. So there's an awful lot that's happening. The tax form is going to change substantially this year. I'm going to provide you with some sneak peeks to some of the forms or portions of some of the forms that we're going to use this year. And then I'm going to conclude today by going through some common errors that we see on individual income tax returns that are submitted to the department. So hopefully when you're completing returns this year, that'll click, and maybe we'll reduce the number of errors that we see this coming year. With that, let's go ahead and let's jump into the tax year 2023 legislation. The first bill I want to talk about is House File 68. This deals with educational savings account. The short title to this is the Students First Act, and a lot of you are aware of this bill and the provisions in it. Sorry about that. My tongue's not working. It's not even Monday. But taxpayers that attend either an accredited non-public school or a public school, they could apply to receive an educational savings account, and they'd receive money that they can use for certain qualified educational expenses. Not a ton of qualifications, but the student needs to be a resident pupil, and there are some household income limits, but only if you're currently attending an accredited non-public school. If you're currently attending a public school, there's no income limits, but you still needed to apply. And for the school budget year beginning July 1 of 2023, the application period ended on June 30. And then for school budget year July 1 of 2024, the application period, I believe, is going to open in January and close in June. But the income limitations that I want to make you aware of is if you're attending an accredited non-public school for the school budget year ending July 1 of 23, the income limit was 300% of the poverty limit. And that's a limit that's published by the Department of Human Services. And then next year, that limit jumps up to 400%. And once you apply and you're approved, you don't need to apply every year. Once you're in, you're in. And a lot of these provisions are Department of Education code sections. So I'm really stepping outside my lane right now, but I wanted to give you a little bit of a background on those. What's important for you as an income taxpayer right now is that there is a division of the bill that addresses the deductibility of income related to the educational savings accounts. So each taxpayer is going to receive a certain amount of money. I think it's like around $7,800, and they're able to use that money for qualifying expenses. And those qualifying expenses are identified in Iowa Code Section 257.11B1B. Okay, so the money first has to be used for tuition and fees. So my expectation is that a majority of this money is clearly going to be allowable, probably for federal and for Iowa purposes. But then money can be used for other expenses. They can be used for textbooks. They can be used for fees or payments for educational therapies, for curriculum fees, software and materials for course study, tuition and fees for online education programs. And I'm not going to list every single one of them, but it is possible that some of this money could be used for a qualifying expense for Iowa purposes, but it may not be a qualifying expense for the federal provisions when it comes down to scholarships and grants. So I just want to make you aware that if a situation does occur and you or one of your clients use some of the money in a non-qualified purpose for federal purposes, and you are required to include that in your taxable income, you can exclude that on the Iowa return, and you're going to report this exclusion, and it's up to the amount that was reported on the federal return on this new Schedule 1, line 19, and you're going to use a code of NN. And I'm going to show you that form in just a little bit, but just plant the seed. I have a feeling a lot of people aren't going to have a problem with this. I have requested some guidance from the Internal Revenue Service about related to educational savings accounts. Maybe we'll hear something from them, but just want to throw that out there. I thought that's important to bring up. Senate File 181. This relates to the retirement income withholding. And this is kind of important because there was a little bit of confusion between the Iowa administrative rules and the Iowa code section. Our Iowa administrative rules indicates that no Iowa income tax is required to be withheld if the income is not taxable for state purposes. And then our code language indicates that withholding is required for Iowa purposes if withholding is required for federal purposes. So Senate File 181, we kind of helped, I guess, propose the language for this bill. And this clarifies that if income is not subject to Iowa income tax, no Iowa income tax withholding is required. And this is important because we have a number of Iowa taxpayers. Their main source of income when they retire is retirement income, and we want withholding to stop on those distributions. If you or some of your clients have a retirement account and there is still Iowa income tax being withheld on those accounts, let me know about it, or have them or you reach out to the plan administrator and make them aware that that's not subject to Iowa income tax. We're also trying to encourage the plan administrators to refund any Iowa income tax that was withheld during this year, since for our purposes, we're considering that an erroneous withholding, and we'd like for them to refund it back because there could be a large number of Iowa taxpayers that would have no income tax filing obligation in the state if that money is refunded back to them, which would be a good thing. And the Senate File 181 change was effective back on January 1 of 2023. I'm just looking at a couple of questions. Someone wanted to clarify that the ESA grants are taxable for federal, similar to the way that regular scholarships are taxed. Yeah, I think that would be an accurate statement, Laura, and I hate to comment on the federal rules. It looks like we have some questions about retirement accounts, and we'll hit some more of those in just a little bit. If I jump ahead to Senate File 565, in Division 1, this bill language really just brought into alignment some of the due dates for making contributions to Iowa educational savings accounts and first-time home buyer accounts, and also the deadline for designating accounts as, say, a first-time home buyer account, or designating a beneficiary, or filing an annual report with the department. The code language for the Iowa Educational Savings Plan and the first-time home buyer account required that these forms be submitted by the original due date of the individual income tax return, which is April 30. And it kind of created an issue in these past few years when we had crazy things like COVID, and the department changed the due date for those tax returns. So then we had a discrepancy. The original due date was April 30, where some taxpayers, that was their deadline for making a contribution to Iowa Educational Savings Account, or that was the deadline for filing an annual report, which is supposed to be submitted with an Iowa individual income tax return, and the return not being due for a much later period of time. But the good thing, this is going to tie all that together, and hopefully nobody will have to think about this anymore in the future. Depreciation clarification. Originally in some of my earlier presentations, I didn't include this slide because I thought nobody's going to ask, and I received a ton of questions on this. And this clarifies that for Iowa purposes, starting in tax year 23, I'm going to ruin the surprise for later on, but our starting point is federal taxable income. And a lot of people have been asking, what about those depreciation adjustments? Back in 2000, I took bonus depreciation, so I have a different basis for federal and Iowa purposes. And now you're telling me start with federal taxable income. Do I lose all that? I can't make those adjustments anymore? Or what if I sell that asset? Am I required to report the capital gain that's used for federal purposes, or is that my only option because I'm starting with federal taxable income? And thank goodness we did receive some clarification. So if you were previously reporting some of those transactions on an Iowa 4562 A or B, continue on and do that the same as you have in the past, and you're not going to lose any disallowed deductions on the Iowa return. So that's a good thing. Filing status, Senate File 565. This was the department bill. Division 3, that clarifies that taxpayers are required to use the same filing status as they use for federal purposes. And this is good for a couple of reasons. One, simplicity. If somebody files a federal return using a married filing status, they're going to be required to use that same filing status for Iowa purposes, married filing jointly. And that makes it simpler for the Department of Revenue when we're comparing information to federal returns. And it makes it really easy on me because I've already developed the individual income tax return for the state of Iowa, assuming that whatever filing status they use for federal, they use for Iowa purposes, because you're going to see in a little bit that one of the first lines on my return is federal taxable income, because that's what the code language says. But there's something that I do want to make you aware of, set-offs. So traditionally, spouses have been permitted to file separately for Iowa purposes to avoid having some sort of a debt offset. Spouse might have an outstanding tax liability. Spouse might have an outstanding parking ticket. And taxpayers for Iowa purposes were able to file separate returns, even though they filed a joint return for federal purposes. And then the department would only go in and withhold from the spouse that had that outstanding debt with the state, and the innocent spouse would receive their full refund. And this kind of complicates things right now because you're required to use the same filing status as federal. Either you could file joint for federal and joint for Iowa, have the debt offset, and then you do have some recourse. The injured spouse can use the process to split the debt, and that'll be described in the notice that you receive from the department. Or you could file separately for federal purposes and file separately for Iowa purposes, but you'll have to weigh the pros and cons of each decision. Sometimes there's penalties if you file married filing separately. Sometimes you don't get all the deductions or all the credits, but I'll let you think about that. But I just want to throw that out there, and I didn't want it to be a surprise later on. We do have some options to seek relief and not have both spouses' refunds absorbed just because of one spouse's debt. Senate File 565, Division 7. This has some issues related to tax return preparers. And there's some good things that come out of this. One of the first sections, it addresses the authority of an individual to act on behalf of a taxpayer, and it gives the department authority to provide this authorization on some prescribed forms by the department, or we can integrate that into a tax return. Many of you are aware of the check the box option that's allowed on the federal return. And okay, we're not going to provide people with full POA, power of attorney authorization by providing information on an individual income tax return, but we're going to provide a disclosure designee authorization. So similar to that federal check the box, you can put your tax return preparer's name on your income tax return. It's not just individual income tax, it's business returns as well. Or you could put your attorney, or you could put whoever name you want on it. And then if you sign it, they're going to have authority to provide information to the department to possibly clear up, some of the notices that come out, some of the questions that come out. So I think this is a big step. And when we get to the 1040, I'll show you the section that you need to fill out, and hopefully this will speed up some of the communication processes between the department and the taxpayer and whoever their disclosure designee is. Division 7 also expands the term tax return preparer to include licensed professionals for purposes of the P10 reporting requirement. Previously, a tax return preparer for purposes of this provision really included anybody that prepared more than 10 income tax returns, and they weren't a licensed professional. They weren't a CPA. They weren't an attorney. They weren't an enrolled agent. They're required to submit 15 hours of continuing education, proof of attending 15 hours of continuing education on an annual basis. And they're also required to put a P10 number on their tax returns that they're signing as a paid preparer. And if they don't provide that P10 number, they could be subject to a $50 civil penalty or a $25,000 annual penalty. And those penalties are allowed for in Iowa Code Section 421.60. Senate File 565 expands this P10 reporting requirement for all tax preparers. So even if you are a CPA, or even if you are an attorney and you're a paid preparer, similar to the federal requirement, you're required to complete the paid preparer section, and you're required to show a P10. So we're really not deviating from the federal government. And quite honestly, a lot of this is intended to address fraud and people that are filing fraudulent tax returns and not completing the paid preparer section. Since we talked about continuing education, I just wanted to throw this in. It seemed like a logical place to put it. But if you are required to submit your 15 hours of continuing education to the Department of Revenue by February 15th, you can go on GovConnect Iowa, and on other actions, you can click on submit an income tax preparer continuing education form, and you can complete the form right there. We're in the process of phasing out the paper return. The good thing about completing this online is you submit it, it's automatically uploaded in our system, and you get confirmation that we received it. In the past, you had no confirmation whether we got your CPE, whether we processed it. Now you know that we have it, and that's a good thing. So this is a win-win for all the tax return preparers, I think, and for the Department of Revenue. Our department bill in Division 8 also addresses a material participation issue that we've had in the past, and I think this corrects it. We're going to talk about some of the 2022 legislation in just a little bit, and there's some provisions that allow for farm tenancy income to be excluded for Iowa purposes, and then certain farming-related capital gains to be excluded. And later on, you're going to hear that to be eligible for some of those exclusions, you can no longer be materially participating in that farming business. And when we're looking at material participation, we look at Internal Revenue Code section 469, and tucked away in that code section is 469H3, which says that if a taxpayer materially participates for 5 of the last 8 years, they're considering considered as materially participating in the current year. And that's great. And this comes into play when I have a farmer say that's slowing down, and in this final year, the final 2 years, they were really retired and they're selling stuff, and this would pull it back in and say, hey, this still qualifies as a year where you materially participate. And some of the people that are just shy of 10 years, it would shoehorn them in. But the problem is that if you meet this requirement where you materially participated for 5 of 8 years prior to retirement, you're always considered materially participating. So you would never be eligible for, excuse me, the farm tenancy exclusion or the capital gain exclusion, because the bill language says you can't materially participate. So this was a win for all of us. So now people can qualify. And when we look at 469, we're going to accept 469H3. Oh, let me jump ahead. Okay, now we're going to jump back to House File 2317. This was signed March 1st to 2022. A lot of these are the farm provisions that I just talked about. Excuse me. And the good news is I do have forms out here, so we can take a peek at a couple of those. I'm not going to show all the forms. I think that'd be boring for you and I. And a lot of these are similar to forms that we used in previous years. But I say these are going to be about farming, and this first one's not, of course. A little curveball on everybody. I'm speaking of that, the Cubs are doing pretty good this year, in case anybody's wondering. I'm second in their division right now. Not too shabby, unusual. I'll take that. Let's start first with the sale of qualified stock. For an individual that has net capital gain from the sale of qualifying corporation stock, and we're going to go through some of these definitions in just a little bit. They are eligible if they make an election to exclude in tax year 23, 33% of the gain from the sale of that qualifying stock. Next year, that's going to jump up to 66%. And then finally, in tax year 25 and beyond, it's going to jump up to 100%. So a good deal for those individuals that met the work requirements and met the ownership requirements. Excuse me, 100% exclusion, it probably isn't too shabby. Let's go through a couple definitions. Capital stock, for purposes of this bill, means common or preferred stock. It means voting or non-voting stock. Capital stock does not include stock rights, stock warrants, stock options, or debt securities. We're going to talk about those in just a little bit. And an employee owner means an individual who owns stock in a qualified corporation for at least 10 years. It was acquired by the individual while employed and on account of employment by such corporation. And the individual was employed for at least 10 cumulative years. Sorry, all this talking, my throat is just drying out. That's okay. We released administrative rules, and the public comment period has closed on the administrative rules. They closed on August 25th, if I remember correctly. But here's a couple of things that we focused in on the administrative rules to help provide a little bit of clarity. Under the administrative rules, if we think about what does it mean while employed, this includes capital stock that was received as compensation. So I receive a bonus and all my bonus is XYZ corporation stock, and I pay tax on it and I receive the stock. I think that would qualify for the capital gain exclusion, assuming I met the 10-year holding period of the stock and I met the 10-year employment requirement for the stock, and capital stock acquired from the exercise of a stock right, a stock warrant, or a stock option would qualify. Just by selling that right, that certainly wouldn't qualify. But if I got stock and then I met the holding period and I met the employment period requirement, that's going to be a win. I do think that would qualify for this purpose. On account of employment, our administrative rules, they state that it must be acquired in a manner only available to employees of the qualified corporation. That means I can't go and open my E-Trade account and buy XYZ Corporation stock, even though I work at XYZ Corporation, and then sell that 10 years down the road. That's not going to qualify. It has to be a plan that's established by the company for the employees to acquire stock. Capital stock that was acquired at formation in exchange for a capital contribution doesn't qualify. So if I formed an S corporation, let's say I have a CPA practice. Many of you know I did have a CPA practice for years, and I formed the corporation and I acquired $10,000 worth of stock. That doesn't qualify. That doesn't qualify. But later on, if I give somebody corporate stock as a bonus, I've said previously that would qualify, but stock acquired at formation is not eligible for the one-time stock exclusion. Just think we could be out golfing today, we could be riding horses today, we could be fishing today, or you guys can listen to me talk for 2 hours. I can't think of what the win is here. A qualified corporation, this means a corporation at the time of the first sale or exchange of stock, that the corporation meets these conditions that are listed on this slide. They employed individuals in the state for at least 10 years. They had at least 5 shareholders for the 10 years prior to the sale or exchange of the stock. And they had at least 2 shareholders, a group of shareholders who were not related for the 10 years prior to the sale or exchange. So something that we'll have to probably track jointly is, did somebody make an election to sell this qualified corporation stock? Because once the very first person, it doesn't always have to be me, and it won't necessarily always be me, but once somebody makes the election, even though the number of shareholders changes because one of the shareholders wants to retire and leaves, and the number of shareholders drops down to 4, the stock is still going to qualify in the future. Just on that very first sale or exchange, it has to know, and if it doesn't meet it then, it can meet it later on. But once it qualifies, it will always qualify. Who's a related shareholder for this purpose? We look to Internal Revenue Code Section 318 to identify who a related shareholder is. That's going to be brothers and sisters, aunts and uncles and nieces. That's pretty straightforward. A qualified corporation also includes any member of an Iowa affiliated group. That affiliated group had to employ individuals in this state for at least 10 years, and that affiliated group must have made a valid election to file an Iowa consolidated tax return. So not that I was eligible to, but I did have to file a consolidated tax return in the state of Iowa. And also qualifying as a corporation that was a party to a reorganization that was entirely or substantially tax-free. So the employee owner is eligible to make a single irrevocable lifetime election to exclude the gain from qualified corporation stock. And again, the capital stock had to be acquired on account of employment. So it is completely possible that I work for two corporations. I worked for both corporations for more than 10 years, and I acquired stock from both corporations on account of employment over the 10 years. Even though I have two qualifying stocks, I only can make this irrevocable lifetime election on one of them. So I need to choose which one is going to provide the most benefit to me. And once I make that election, I'm locked into it. This election also applies to all subsequent sales or exchanges within 15 years. So I make the sale for the next 14 years. I can still sell off stock under an installment basis over the next 14 years, or I can sell off blocks of shares over the next 14 years. And those shares obviously still had to come from that employer purchase plan, but all that's going to qualify over the next 14 years. So there's some planning that you might be able to do. The qualifying capital stock will also apply if it's transferred by inter vivos living gift from the employee owner to their spouse. And they can transfer it to the spouse. They can transfer it to a trust for the benefit of their spouse. And this will work. And the important thing is that on the date of that transfer, that individual that's receiving the spouse must still be a spouse of the taxpayer. On the date of the transfer and or the date of death, if the transfer wasn't complete, but the assets go to the spouse. If an employee owner dies after selling or exchanging the stock, but without making the election, the surviving spouse or their personal representative can make the election on the tax return. And I'll talk about that a little bit on the return, which is right here. So here's some exciting news. I have a form number for that. So if taxpayers are going to claim an exclusion for the sale of qualifying capital stock, they're going to report that on the Iowa 100 Schedule J. And again, for tax year 23, they're allowed a 33% exclusion. And then I'm going to jump in. I'm not going to go through this whole form, but generally we're going to ask some qualifying questions on the Iowa 100J. What's the name of the corporation? Are you making a single lifetime election, or have you previously made an election to exclude stock from this qualifying corporation? You know, if you say no, you're done. The form's simple because you're not eligible and you don't have to fill anything else in. If you answer that you are making the election or you previously made the election, we've got some more questions for you. And I didn't post all the whole form out here, but then we're just going to ask questions about when you acquired the stock, your years of employment, and it can vary in ranges. It doesn't have to be 10 consecutive years that you work for that qualifying corporation. It might be 5 years and 5 years, and we just want you to document that and prove that you qualify for the exclusion. And then we also talk about making the election on behalf of a deceased taxpayer. So the Iowa 100J, that's the form that you're going to be looking at if you want to make that capital stock election. Let's jump into some of the retired farmer exclusion rules. We're going to start off with the farm lease exclusion. And this also is effective for tax years beginning January 1 of 23. Taxpayers can exclude from net income amounts that are received from a farm tenancy agreement, farm tenancy income. To qualify, the property had to be held for 10 years, and you had to materially participate in the farming business for 10 years. And the form is going to incorporate a lot of the questions that we used in the past for the capital gain exclusions. For this purpose, farm tenancy agreement, that means, and what's that first word on the slide that's bolded? a written agreement that outlines the rights and obligations of the owner and leasee. And we look to Iowa Code Section 562.1A to determine what a farm tenancy agreement is. So remember, I pointed at that bold figure. It's got to be written. And I mentioned before that I did have a tax practice, and it wasn't uncommon in my practice for family members, for neighbors to operate off a handshake. But for this purpose, if you want to exclude the farm tenancy income, the agreement has to be in writing. Our administrative rules indicate that it also has to be an arm's length transaction. We don't want anything unusual happening. I can't think of the correct way to state that, but we want to make sure it's arm's length. It's a rent or an arrangement that would be signed by a willing leaseor and leasee. Okay, so what is considered a farm tenancy arrangement? And the most common arrangements that are found under 562.1A. First is the cash lease. That one's pretty straightforward. I pay you $250 an acre, and then I can go out and I can farm your land, and pretty straightforward. The second most common one is a crop share lease arrangement. Again, in counties that I operated in, it's fairly common to have a 50-50 crop share arrangement where I would agree to pay half of the input costs, the seed, the fertilizer, the lime, repair, maintenance, even equipment. And in return, I'd receive 50% of the income from the sale of corn or the sale of beans. I think that's probably easy peasy. And then finally, there's livestock share lease arrangements. Same thing as the crop share lease arrangement, but now substitute some cows and feeder pigs in there. Again, I'm sharing in the expenses, and I receive the same share of income. I've had a number of individuals ask about CRP land. Does that qualify? Short answer is no. There's no farming business that's involved. They've signed an agreement to essentially not farm. So if you or your clients are receiving some CRP income, we don't believe that is going to be eligible for the farm lease exclusion. Some of the eligibility requirements, the individual must be either disabled or age 55 years or older at the time that the election is made. The individual can no longer be materially participating in a farming business. I'm going to repeat that again because our rules are real similar for the capital gain exclusion. So for our purposes, we're not expecting to see that taxpayer paying self-employment tax on their Schedule F income. We're not expecting that individual to be receiving a K-1 showing that they're a general partner in a farming partnership. So again, they can no longer be materially participating in a farming business. And the owner leaser must be a party to the farm tenancy agreement. So it's not possible for me to rent my land to my neighbor, who in turn enters into a crop share arrangement with another neighbor. That doesn't work because I didn't enter into an agreement with somebody that's operating a farming business, so I'm not eligible. And my neighbor's not eligible because they don't own the land. They've got to own the land. They have to be a party to the agreement, so that wouldn't work. Materially participated, that means the same thing as material participation in 469H. Remember, except 469H3 is accepted when we look at 469H. Here's some definitions of what a farming business is, what livestock means. I'm not going to go through those. If you want, you're more than welcome to go out and look at our code sections or our rules. An individual who elects to exclude income from farm tenancy agreement cannot in the same year or in succeeding years claim a capital gain exclusion, which we're going to cover in the next slides, or the beginning farmer tax credit. So once I've made an election, again, at any time in the future, I can't claim that capital gain exclusion, and I can't claim the beginning farmer tax credit. Even if that beginning farmer credit is carrying forward, I'm done. So I probably need to do some planning before I decide which way to go. But in my mind, 100% exclusion for farm tenancy income is more of a benefit than claiming the beginning farmer tax credit, but you'll have to weigh the pros and cons of that. Married individuals who file separate returns, I think this is pretty easy. You just allocate the exclusion based on the pro rata share of net income from the farm lease income. And each spouse should report the farm lease income on their own 4835 or Schedule E. I think that's pretty straightforward. Partnerships, S corporations, trusts, and estates, they're not eligible for the election, even if that income passes to an eligible individual. So let's say you have a partnership, and obviously all the income passes out to the partnership, and the partnership has crop share arrangements. That farm tenancy income that passes through the partnership out to the partners isn't eligible. Same thing is true of a trust. But I think there is an exception to that. If you've got a disregarded entity, if you've got a single member LLC, or if you or a client has a revocable trust, which is considered a disregarded entity for tax purposes, in our eyes, the entity doesn't exist. So I believe those would qualify for the farm tenancy exclusion. So here's the form that you're going to want to look for, the Iowa 125 form. That's where we report the farm tenancy exclusion. Again, this form, first time you're going to be able to use it is tax year 23. When you open the form, we're going to go through some qualifying questions. You know, like at the very top, are you an eligible individual? Are you disabled? Are you age 55 years or older? And if you say yes, you keep going through the form. If you say no, then we send you down to part 2. I'll show you that in just a second. And part 2 is, are you a surviving spouse? There's another option there. Are you a surviving spouse? Otherwise, I'll look at some of the questions here under part 1. So I'm saying, okay, I am an eligible individual. Question 2, do I want to make a single lifetime election? You know, if I say, no, I don't want to make it now. Okay, you're done. You don't have to worry about completing the rest of the form because you don't qualify, because the only way you can exclude farm tenancy income is if I make a lifetime election to exclude that income, and I didn't claim the beginning farmer credit, and I haven't made the election to exclude the capital gain. So yeah, okay, I'm saying, yeah, I want to make that single lifetime election. And then we roll down, there's the questions asking, hey, have you claimed a beginning farmer credit? Are you a retired farmer, and did you elect to exclude the capital gain income? So I think we've got a good handle on all these forms, and the flow all works. And I got my fingers crossed they all work during tax season. And then if you are a surviving spouse, you know, we ask, was the taxpayer eligible to make the exclusion? It's like, no, he was only 54 and not disabled. Okay, you're done completing the return. If the taxpayer was eligible, then we go on, we ask for the date of death. We ask if they made an election to exclude the farm tenancy income, And then if you go to the instructions, you can see how to make that election for the deceased taxpayer. If they passed away this year, I can go in and I can make an election on their behalf. And then we also discuss how to disclaim an interest as well. It's for farm tenancy income and for the capital gain exclusion. Okay, let's stop and talk about that for 1 second. If we have a taxpayer that qualified for the farm tenancy exclusion, I made an election, I'm married, and my spouse has their real property, I have my real property, and I make the election. I just have one parcel. I make an election to exclude that farm tenancy income. I pass away. My spouse, for this purpose, really inherits that exclusion. Whether or not they qualify on their own, they inherit that exclusion. So they have their own property and they inherit my property. They've got some options. One, they can just go ahead and continue on with the election I made on that property. We'll call it property A. So from this time forward, I can exclude the farm tenancy income on property A. On property B, I can make my own election on that, assuming I'm age 55 or older. Being a surviving spouse, I can make my own election on that property. So I could choose to exclude the capital gain income. I could also choose to exclude the farm tenancy income on that property. But that tie severs when my spouse passes away. I inherited their property A, and now I can't be alone, so I remarried. And now when I pass away and that property passes over to my spouse, that farm tenancy exclusion that was allowed on property A doesn't go out to that new spouse. And that seems to make sense. But, okay, make a note, it's the Iowa 125 form that we're going to use to report the farm tenancy exclusion. Okay, our next point to discuss is the retired farmer capital gain exclusion. And a lot of this is going to be kind of similar to our old capital gain rules because it's the farming provisions that carried forward. You can see some of the definitions for the capital gain exclusion, which are similar to the farm tenancy exclusion. We have some of the same definitions for what a farming business is. So I'm not going to dig into those real deep right now, but I just wanted to point them out because I know some of you can't sleep at night. You can't help but look at the Iowa code and find out what an Iowa farming business is. But I'm going to stop on this slide to talk about what a relative is. So for purposes of the capital gain exclusion, a relative satisfies one of these conditions. One, an individual related to the taxpayer by consanguinity, which is a relationship by blood, or by affinity, which is a relationship by marriage within the second degree, or it's a lineal descendant. So that would be parents, grandparents, child, grandchildren. And then that third bullet point is just, I just think it's kind of odd, but it's an individual that satisfies one of those first two requirements that has an equitable interest in a partnership, an S corporation. So it is possible that my son could have a 1% interest in a partnership, and that partnership could acquire my property. And they're considered a relative for this purpose, just having that 1% ownership interest in a partnership. The definition of a retired farmer, this is similar to the farm tenancy exclusion. It's an individual that's disabled, it's an individual that's 55 or older, and it's somebody that doesn't materially participate. Remember, we said before, we don't, after you make this election, we don't expect to see a Schedule F on your return. We don't expect to see that individual being a general member of a farming partnership. I don't even think that we expect to see a W-2 from an S corporation that's a farming business. A lot of that we're working through with the administrative rules. Things are going to get a little murky right now, talking about the capital gain exclusion, because there's a couple paths that we can go, depending on whether you're a retired farmer for this purpose, or whether you're just selling real property and you meet these requirements. So let's focus in on the real property right now. I want to sell that and I want to be eligible for the exclusion. I've just got a couple options, let's put it that way. I won't say a couple requirements, but there's two paths I can take here. One, if I materially participated in a farming business for 10 years and I held the real estate in a farming business for 10 years and I sell it, I'm eligible for the exclusion. That's pretty easy. And then option two is I held the property, doesn't have to be 10 years. I didn't have to materially participate for 10 years, but I held the property and I sold it to a relative. So I sold it to a son, I sold it to a daughter, I sold it to that partnership that my son has a 1% ownership interest in. That qualifies for the exclusion. We have some exceptions in the end, but for right now, you qualify for that. Okay, now things are going to get a little bit murkier. If I want to sell some breeding livestock, let's say I'm selling cattle or horses that are held for breeding, draft, or dairy purposes, and they meet the 24-month holding period, or I'm going to flip to the next side, all other breeding livestock besides cattle and horses, and I met a 12-month holding period. I sell those. I want to exclude the gain. I can make a single lifetime election, but once I make that single lifetime election, that pulls your real property in too. And then you're committed to this thing. It's not like I can continue selling my real property and just meet that 10-year holding period and 10-year material participation. Once I make the single lifetime election, it's pulling everything in. And again, here was the exceptions down at the bottom of this. A retired farmer who makes the single lifetime election shall not claim in the year or any subsequent years the beginning farmer credit or the exclusion from the farm tenancy income. So once I make this election, I'm in, I'm committed to it. Individuals who file separate returns, again, similar to the farm tenancy exclusion, I think this is pretty straightforward. You allocate your exclusion in the same proportion that you allocate the capital gains from the sale. So your breeding livestock and the capital gains that come from the real estate that's sold. A big thing, in case you haven't heard me say it before, installment sales. Previously, the capital gains that were received from installment sales that previously qualified for the capital gain exclusion were all set to expire. Pardon me. They're all set to expire beginning January 1 of 23. So if I had a taxpayer that had real property that was not used in a farming business, I sold it under an installment arrangement, it previously qualified for the capital gain exclusion prior to enactment of House File 2317. All those capital gains were going to be subject to Iowa income tax. There was no exclusion that was available, but House File 2317 revived those exclusions, and I'll show you a copy of some of the forms here in just a second. So if you sold those under an installment arrangement prior to 23, you'll still be eligible for the capital gain exclusion. Kyle, we're bumping up against 1 o'clock right now. What would you think about maybe taking a 5-minute break? What do you think about that? And then maybe we can look at some of the questions and we'll come back and start going through some forms.
Yeah, I think that's a great idea. Let everybody get up, stretch their legs, do whatever they need to do. How about we come back, like you said, at like 105 or so? We'll just kind of chill out for a little bit. If anybody has any questions, feel free to keep adding them to the Q&A, and uh, we'll see where we go from there.
All right, perfect. Thanks, Kyle.
Yep. If anybody didn't hear us, what we were saying before, we're going to take a short break until 105, just so everybody can get up, stretch their legs and everything. It's already been an hour. We will come back in a couple of minutes, and Kurt will finish up. Thanks. All right, so for everyone here, I'm gonna throw out some accounting jokes to you. I mean, I don't know everybody who's in the audience, but maybe you'll like these, maybe you won't. I'm not entirely sure. My boss is listening to these. Don't fire me if they're dumb and this is not appropriate to do. But let's give you a couple jokes until we get started in about a minute or so. So where do homeless accountants live? In tax shelters. Ah ha ha ha. Super hilarious. I know. I know that I mean, how many people are here with us right now? 806. That's crazy. So I know there's at least one person out there that laughed at that joke. I hope. I don't really know. Kurt, I'll let you take the stage, man.
Yeah, that's pretty good. I might repurpose it.
Oh, there you go.
I may reuse it. I did make note of some of the questions. We'll hit some of those at the end. We'll fly through those. Let's see if we can get to the slide deck.
Okay.
Okay, so for a taxpayer that's going to claim the Iowa capital gain deduction, there's going to be one of two routes that you're going to go. One, if you're a retired farmer, in most cases, meaning that I want to exclude some of the gain from the sale of the breeding livestock and the real property, I'm going to complete the Iowa 100G form. And again, this is for tax years beginning January 1 of 23. Let me jump down to this slide. And we're going to go through some qualifying questions on the capital gain exclusion as well. Is the taxpayer retired? You know, and if you're like, no, then we're sending you down to part 2, and we're going to ask questions about whether you're a surviving spouse or not, and whether you can qualify. And then we're going to ask some questions about whether you're making the election to exclude the qualifying capital gains from breeding livestock. If you answer that as yes, we're going to receive information on that. If you say no, we're going to send you over to the Iowa 100H form, which is just for real. If I'm just selling the real property, I can just complete the 100H, which is coming up in just a little bit. And then, as usual, we're going to go through and start asking, you know, are you claiming the beginning farmer credit? Have you made an election to exclude farm tenancy income? And based on all these questions, we're going to give you a path on which form you should go to. Possibly you don't qualify at all. Are you a surviving spouse? And if you are, we're going to jump to that page as well. And here's the surviving spouse section on this form. And again, if you are a surviving spouse and you're eligible, you're going to report the decedent's date of death. You're going to report whether the taxpayer made an election to exclude the capital gains from the sale of real property or from the cattle and the horses. And then we're going to ask about whether your spouse made the election. And if they didn't, and you want to make the election, we're going to tell you how. And if your spouse made the election and you want to disclaim that election, we're going to tell you how to do that. Also, I don't know if I mentioned this before, but if my spouse makes the election and I decide I don't want to exclude the farm tenancy income, probably because I want to sell the land, I'm able to disclaim that interest if I make that valid disclaimer by the last day of the tax year following the date of by the due date of the tax return following the date of death. So if I pass away in 2023, my tax return and my deceased spouse's tax return is going to be due by April of 25. And then I'm going to have until December. I'm going to have through December of 25 to make that disclaimer. I might need to think that, but I think that's right. I think it's the last day of the year. It's the due date of the tax return following the year of death. I apologize. So it would be April of 26, I believe. But I'll have that spelled out in the instructions. So I think I do have until the due date of the tax return following the year of death to make that election. So if I'm just selling real property and I'm not selling breeding livestock and I want to exclude the gain from that real property, I could complete the Iowa 100H. Again, this form is for tax years beginning January 1 of 23. And this form, I'm not going to go into it in very much detail because this really just mirrors our old capital gain exclusion form that related to the sale of real property that was used in a farming business. So I don't think there's a lot of lines that we really even need to discuss on this. Okay, now we'll jump away from the forms for just a second and we'll go through some of the additional provisions that were contained in House File 2317. Here's the individual income tax rates for tax year 23 through 26. You can see in tax year 23, the highest rate is 6%. By the time we get out into tax year 26, that top rate drops down to 3.9%. So rates are really dropping. I think that's going to help a number of taxpayers. Retirement income isn't taxable. I think that's going to help a lot of taxpayers. And then make sure you see the note at the bottom. If you've got a taxpayer that's filing a joint return, married filing joint, you double the brackets, okay? And unlike federal, we don't have a special rate for like a qualified widower. Under House File 2317, we have rates for married filing joint, which is double these rates, and then we have rates for everybody else. And I just wanted to clarify that. And with our shiny new system, I wanted to point this out as well. We're moving away from the rate tables. A lot of people are used to seeing those tables when they open our paper booklets, which are, I'm not going to say they're going away, but they're used very little anymore. And we're going to rate schedules. And our new computer system is going to calculate tax liabilities down to the penalty. So make sure that you and your software providers, that you round everything when you're preparing tax returns and you round it down to the penny. Otherwise, it's very possible that you or your clients will receive correspondence when they start filing tax returns for tax year 23. You receive correspondence that's notifying you that we've rounded your liability or your refund up pennies. So if you round it, that's going to reduce the amount of correspondence that goes out in a single year. Here's some of the alternative tax rates for tax year 23 through 26. Retirement income exclusion contained in House File 2317. There were some questions that I saw earlier, and hopefully I can address some of those right now, but I think this is a really good thing. Essentially, this bill removed the limit for the retirement income exclusion. Before, it was $12,000 for taxpayers that file married filing jointly and $6,000 for all other filing statuses. And this is a big deal. I think I mentioned earlier that we're trying to get plan administrators to stop withholding and hopefully refund amounts that were withheld in tax year 2023 erroneously, so some taxpayers would not have to file. A couple of the questions out there before I keep on rolling. One, would an inherited IRA qualify for the exclusion? Yes, I think they would, as long as the recipient is age 55 or older, or they're disabled, or they can show that they had an insurable interest in the decedent. That would certainly qualify. Someone else asked them, so is anybody that receives a 1099-R, is that income going to be excludable for Iowa purposes? And the answer on that, no. I'm not going to say all. All's a big word. I think a lot of us learned that in school, when you see answers to questions that say all in every, those questions often are not correct. And that's true in this case as well. It's not anybody that received a 1099-R. It would just be the beneficiaries that are age 55 or older, disabled, or have an insurable interest. Someone asked if they can get a refund in 24. I think they're still talking about the retirement income exclusion. So I think the answer to that is yes. If you don't have the Iowa income tax that was withheld from your retirement income returned back to you, you're going to get your 1099-R. It's going to report the Iowa income tax that was withheld during the year, and when you file your return next year, it'll reduce your tax liability or increase your refund. So it's really not a problem. There was one individual that indicated that there was a fund company that is still withholding, and my contact information's at the beginning of the slide, but you may want to send me an email, and then, because I have talked with this company before, so there might just be a communication gap, but send me an email and we'll talk about that retirement company. And another person asked if there's a penalty for plan administrators that continue to withhold. And there is not, and I'm going to argue that there should not be. And I'll tell you the reason behind that is there is a penalty for an administrator or an employer that doesn't withhold when they're required to withhold. It would be kind of awkward to create a penalty for someone that withholds more than they're required to withhold. That would be like a town that issues possibly speeding tickets if you drive over the speed limit or if you drive under the speed limit. I don't know. I wouldn't drive in that town. So that's the reason why I'm saying no, there is no penalty if a company withholds when they shouldn't. But there is a penalty if they don't withhold enough. Okay, let's keep going. I think that covers a chunk of the questions that we had out there. And then pay attention, the note at the bottom of this slide. Previously, when we were determining when a taxpayer had to file a return, and that's for, like, look at the top of the slide. If you have an individual that was filing as single, their filing requirement was if they had $9,000 of income or less. If they're 65 or older, it's $24,000. And before, when we were determining whether we met that threshold and we were required to file an Iowa return, we were required to add back the amount of retirement income that was excluded for income tax purposes. And a great thing that House File 2317 is they removed that requirement to add the retirement exclusion amount back again, meaning that more Iowa taxpayers won't be required to even file a return. So I think that will reduce an administrative burden for them, which I think is a good thing. We did publish some guidance related to the retirement income exclusion. We're working on the administrative rules right now. Quite honestly, this was a lot more complicated than what I ever intended it to be. I'm getting a frog in my throat again. But if you go to our website and you search for retirement income exclusion guidance, you're going to find this page. And we've identified some of the plans that we think qualify for the retirement income exclusion. In our administrative rules, we'll identify some that we think clearly do not qualify. I think our focus is primarily on Internal Revenue Code section 408 to identify what is a qualified retirement plan. I'm not going to go through all the plans that are listed on here. Some of the ones that we think do not qualify are the non-qualified plans. Those would be like non-qualified deferred comp plans, non-qualified annuities. I don't think any of those would be eligible for the retirement income exclusion. And hopefully we'll have these administrative rules published shortly, then we'll open them up for public comment. I expect there to be conversations when we release those for public comment, and that's good because we want to make sure that we get the administrative rules right. So I enjoy getting feedback when we do publish those administrative rules. Okay, I'm going to jump back into House File 2552. I don't think that we need to talk about the VSP filing requirement. I mean, that's in the past. Before, taxpayers were required to submit that because we didn't have this cool computer system that could add up all the withholding that was reported on the monthly or quarterly reports and tie those to the W-2s and 1099s. But now that everything's being submitted electronically, we don't need the VSP. So that was rightfully discontinued. But I want to remind people about the $500 civil penalty that is allowed for in House File 2552 if a company has say employees, because we're looking at income statements. This is 1099s or W-2s. And if that employer would fail to furnish, or they would furnish fraudulent statements to employees or to the Department of Revenue, they can be subject to a $500 civil penalty for each occurrence. So I've got 10 employees and I did not provide them with the W-2s. I could be assessed a $5,000 penalty for not giving those employees their W-2s. And I could also be assessed another $500 penalty for not giving a copy of those W-2s to the Department of Revenue. So potentially I could receive a $5,500 civil penalty for not providing those W-2s or 1099s. Quite honestly, the Department of Revenue just wants to make sure that employees and contractors, if you're issuing 1099s and you're required to withhold, are receiving timely statements so they can meet their tax filing obligations. Remember, we talked about our mission and our vision. So if we discover that you haven't filed those, we will contact you by letter. The intent isn't to immediately assess these $500 penalties against you. You will be provided, I believe, with a reasonable amount of time to comply or show that you thought that you complied and correct things. But if not, potentially there's a $500 civil penalty that could be assessed. When you or your clients are submitting their Iowa withholding, their quarterly or their annual reports, I want to make sure that you know that you should be using the new 9-digit account number with all withholding filings. For a short period of time, for that transition period, we still allowed that 12-digit number to be used. But right now and going forward, you should only be using that 9-digit account number on your reports that you're submitting. Let's jump all the way back to 2018 and talk about some of the contingent changes that are no longer contingent that are all going to come into play in tax year 23. And I promise you, this is where we're going to see some of the new forms, because I know you're interested in seeing some of those. The formatting is kind of wonky on some of them, but I wanted to get them on here so you could see them. So the first thing that is very important is that our starting point changes. And I know I spoiled this earlier, and I just hate that I did. Not really. But the starting point changed from federal adjusted gross income to federal taxable income. So remember, that's after the federal standard deduction. That's after the federal itemized deduction. So all those are allowed for Iowa purposes. The Schedule A, the itemized deduction schedule for Iowa purposes, is gone because we're using the federal standard deduction. We're using the federal itemized deduction. So that's a huge change. And then also with net operating losses, with Senate File 2417, you're still going to be allowed to deduct net operating losses that occurred for Iowa purposes prior to January 1 of 23. But you're also going to be required to remove any net operating losses that are carrying forward on the federal return for tax years prior to 23. And I've got a form to help you track that. And we'll cover that in just a little bit. We've already talked about that married filing separately on a combined return. That status is gone. So now I can file married filing joint, or I can file married filing separately. And remember, I need to use the same filing status that I used on the federal return. Alternative minimum tax is repealed. But in tax year 23, this coming year, I'm going to have a one-time allowance to use any AMT credit that's carried forward. So this is my last chance to use up that credit. Otherwise, alternative minimum tax goes away, and I think that's a win. Reduces the complexity of the Iowa individual income tax returns. The deductibility of federal taxes, that goes away too. It's going to be repealed. And again, similar to the AMT, there's a one-year transition period. So in tax year 23, you're going to be able to deduct on the 23 return the federal taxes that were paid for prior tax years. You're going to be able to deduct estimates, that were paid for prior tax years. I can't say withholding, because if there was withholding in 23, that would be for 23. But by the same token, if I receive a federal refund and I deducted that federal tax in a prior year, I'm still required to report that refund as income in the current year. So this is the last year that you're making those adjustments for the federal tax paid and the federal refunds that are received. And then again, easy peasy, those go away. Some other changes that I want to make you aware of: if your employer, this would be a great thing, if they pay off all or a portion of your student loan, and that's included for federal tax purposes, you're going to be able to exclude that for Iowa purposes. That's a win. Senate File 2417, they did have their version of the capital gain deduction related to the sale of real estate and a farming business, but all that's been modified in House File 2317, so we won't cover that right now. There is a change for the health insurance premium deduction. Before, you were able to deduct health insurance premiums as long as it was paid for with post-tax dollars. That is still true, but there is a qualifier on that. The taxpayer has to be age 65 or older, and their income has to be below $100,000. And it's my understanding that $100,000 is by filing status. So a single taxpayer and a taxpayer filing a joint return, the income limit for both is $100,000. It doesn't double for the married filing joint taxpayer. Filing status, we talked about that with Senate File 565, that we have to use the same filing status. I wanted to let you know that forms have been released to developers. The individual ones, the main forms, the ones that had the most changes, were released to program developers on August 31. You're going to see in just a minute, there's some substantial changes to the 1040 form. We did reach out to the software developers. We let them know of the changes. We let them know that they're substantial, and we gave them a date that we're going to have those released so they could work on those. Because like you, I don't want there to be any glitches this year. And then we always give the software developers test data to run through the software to make sure they're getting the same number that we're getting. And we're going to do that again this year. And any new forms that we have, we're going to run some test data through that just to make this tax season easier for you and easier for us as well. But let's take a peek at some of the forms, and I'll point out some changes that I think you should be aware of. One, on the 1040 form, you can see it. There's a box up here. We add in a box if this is an amended return. If it is, check the box. The 1040X is gone. Okay, for tax year 23, we want you to submit the Iowa 1040. We want you to check that box indicating it's an amended return, and then we want you to attach a copy of the Iowa 102 form. And I've got a sneak peek coming up of a new section on that Iowa 102 form. You can see down here in the filing status, no longer have married filing joint on a combined return. And then down below with the dependent section, before we just asked for some names, now we're asking for the same information that's contained on the federal return. We want first name, last name, social security number, and relationship, because we want to confirm that that same dependent isn't claimed on multiple tax returns. And we do, again, have this new system that has a lot greater capability and capacity than our old system had. and this is just a little bit further down the page, but you can see our top line on here is federal total income. And you're going to see when I look at the 126 and 130, we need that information to accurately calculate the part year, the part year tax credit and the non-resident tax credit. So we need that information. So we're going to ask for it. Then line 2, that's the line I've been excited about all day. Federal taxable income. That's really our starting point. Yippee. So we start with the federal taxable income. And then on line 3, that's where we make all the modifications, things that are different. Differences that are allowed for on the Iowa return are all going to be accounted for on that Iowa modification schedule. And then this is easy. After that, we calculate Iowa taxable income and we're up and running. There's a box here. If you used an alternate tax computation or a low income exemption, if you qualify for the low income exemption, we got a box for you to check on there. But otherwise, this thing's easy. And for your average taxpayer that just has W-2 income, it's like, I'm done. I fill out those, I calculate my tax and my withholding, and I get down to the bottom and I sign it. A little bit more complicated if we got some retirement income, if we have Social Security that was taxable for federal purposes, but we'll look at that. So we calculate the tax, and then this bottom section down here where we have all the non-refundable credits, that is the same as prior years. So I don't think we really need to talk about that. Then up in step 6, that's where we have the refundable credits. That section is pretty much the same. Note on line 27, we've added the PTET credit, which reminds me, on the 19th, Mike Mertens has a 1-hour webinar just on the PTET tax credit. So I'm not going to dig into it real deep right here, but we're going to combine that with the composite tax. We'll report it on the schedule CC, and then we'll keep on moving. Other than that, I think the rest of the information on this schedule is really the same. If you're a farmer, fisherman, we're going to have you check the box this year. Otherwise, if you have someone that completes a Schedule F and they've met the requirements, they submitted their farm tax return by March 1, they paid the balance due, we want you to submit that 2210F form to show that you are eligible for the exception to the penalty. Otherwise, we don't know that you're a qualifying farmer. So plant that seed as well for this coming tax season. Schedule 1, here's the one. Somebody asked that in the questions, is where do we report the modification? Schedule 1 is it. Oh. Kyle, I must have dry air here. It's making me cough a little bit.
Hey, you're doing great. I'm proud of you.
It's drier out here in Monroe, Iowa. Okay, so Schedule 1, that's the one that we have the modification. So just like, for instance, up on line 1, interest income. If for federal purposes, I had U.S. Treasury bond interest, and it's not taxable for Iowa purposes, here's where you do the subtraction. Or maybe there was some U.S. bond interest and we need to add that back for Iowa purposes. This is where we make all the adjustments for that. You can see on line 5, if there's Social Security benefits that were taxable for federal, here's where you back them out. Active duty military pay, pull it out here. Line 7, your retirement income. We've been talking about retirement income quite a bit today. That's where we make the adjustment for it. Let me see if there's something else unusual. The net operating losses, we're going to look at that Iowa 124 form in just a second, but we're going to have to calculate what the add back is for federal purposes, figure out what, excuse me, the Iowa deduction is. Your health insurance deduction, that's going to be reported on line 15. Remember, got to be age 65 or older have income of less than $100,000. Federal taxes paid for prior years. We make an adjustment down here for that. And I think that covers most. Oop, let me go back. So again, your modifications are going to show up on Schedule 1. There's just going to be a net modification that's carrying forward back to page 1. And then we go ahead and calculate the amount of tax for Iowa purposes. Down in step 9, this is the third-party designee section. So this is going to appear right before the signature. But if you want your tax preparer to have the ability to talk to the Department of Revenue, or you want your attorney, or you want, I don't care who it is, whoever you list on there is going to have authority to discuss your tax return with the department. So I'm guessing that 99.9% of the time you want your tax return prepared to sign that, because you want them to be the one that's talking to the department and providing information for us. Remember, it's not full power of attorney authorization. They can't act on your behalf, but they can provide information to help resolve any questions that you might have with the Department of Revenue. And finally, we have the signature section. I don't think it's anything really new to discuss with that signature section on the return. Iowa 126. This changed a little bit. If you remember right, previously on the non-resident part year resident credit form, we had columns for, who can guess it, taxpayer and spouse. And remember, we're not filing married, filing separately on a combined return, so don't need that anymore. So now, and I think the final version of this form really is going to have 2 columns, but this first one will be blank on this page. You're going to have all source income and Iowa source income. But this all works out. So in part 1, you're just reporting the Iowa source income on lines 1 through 13. And then remember, I told you we needed that total Iowa income. And we do, if I jump down to 5B, there's where we pull in the amount of the total federal income that was reported on your return. We make adjustments for any Iowa modifications to the federal income that was reported. And then just like the old Iowa 126 form, we're going to allocate, I guess we'll look at some of the deductions that you have, ones that will apply to all source income, and what applies to column B is the Iowa source income. We'll figure out a percentage, and then we'll calculate a credit on this return. So really just the top portion changed the most because we got rid of the taxpayer and the spouse, and we're combining everything. If I jump ahead to the Iowa 130 form, the out-of-state tax credit, this form really just requests a little bit more detail. Previously, we didn't ask for a breakdown of all the income, but this is really identical to the Iowa 126. We're asking for all the income. In this case, that was taxed by another jurisdiction, and the lines are identical to the 126 for lines 1 through 13. Then line 14, again, it's asking for the amount of the federal total income. So again, we need to know what that dollar amount is to do some of the proper calculations for the part year resident credit and the out-of-state tax credits. But I don't think I want to dig into this form too much deeper, but I want to give you a sneak peek of it. The bottom portion of the Iowa 130 is identical. It really is identical to the prior year. Iowa 100 A through F. Remember, if you had a capital gain that previously qualified for the exclusion, and you sold the property under an installment arrangement, you're going to be able to continue to exclude that income. So we've modified the Iowa 100 A through F forms. We noted on the forms that this form only should be used for installment sales that occurred prior to January 1 of 23. And then on the forms, we jump right in and ask, did this sale occur prior to 23? And if they say no, we're going to disqualify you right away, unless it's one of the forms that relates to breeding livestock or the sale of real estate used in a farming business. And then, like in number 2, we're going to send you off to our new form. If the sale occurred after 23, excuse me, we're going to send you off to the new form to see if maybe you qualify using the Iowa 100G or the Iowa 100H. And other than that, the Iowa 100A through F really is similar to prior years. Again, I mentioned if you check the box on the face of the 1040, we want you to go complete the Iowa 102 form. And these are all the forms that require the 102 to be attached if the return is being amended. One thing I wanted to point out, though, is on the 102 form, we modified page 2, and on line 11, one thing that was lacking on the old Iowa 102 form is a line to apply any overpayment to the next period. So we've added that line. So I think that makes everything work. Remember that I can only put an amount there is if I amend this return prior to the last day of the subsequent tax period. So if I want to amend a 2022 tax return, I need to amend that by December 31 of 23. The return was due in 23, and I got till December 31 of that year to file this amended return and apply that payment to that subsequent tax year. So I wanted to point that out. I thought that was kind of a big change. Any change you make to a form is kind of a big deal. There's a lot of work that goes into it. The Iowa 124 form, that's the form that's going to be used to track your NOLs. Remember, I told you if you've got a pre-23 federal NOL or pre-23 Iowa NOL, you need to track it. And the pre-23 federal NOL, that's going to be an add back. Because remember, we start with federal taxable income. It's already going to be included in the federal return, but you're not allowed to take it. So we need to add it back. So part 1 of the Iowa 124 is going to be used to track that NOL. You start off reporting the amount of the pre-23 NOL. You report the amount of the current year NOL. And then on line 3, that's where you calculate the amount of your add back. It's a lesser of line 1 or 2. And then line 4, that's going to be your carryover amount. So when you complete next year's Iowa 124 form, line 4 moves up to line 1. That's the amount of the remaining pre-23 federal NOL amount. And then you go through this calculation again. And then down in part 2, you're really doing the same thing for Iowa purposes. Really, I think the only difference is on line 2, if part of your NOL expired just due to that 20-year limitation, we'll remove that on line 2. Otherwise, we go through the same scenario. We start with the amount of the pre-23 Iowa NOL that's carrying forward. We remove the amount that's expired. We determine the amount, the lesser of the carryover amount or the amount of the current year loss, and determine just the amount of the allowed current year Iowa NOL. And then we back that off of the beginning amount and determine the carryover. So line 6 is going to end up being line 1 in tax year 24 after we determine the amount of the Iowa NOL that was allowed in the current year. So I think these forms are logical. And this is a lot better. I think a lot of you would agree. This is going to be a lot easier to complete than the old Iowa NOL forms. I've completed them a few times when I was in practice, and they were kind of tough to get through. And this one's easy. Just start with the beginning amount, figure out how much is used or added back this year, back it off, and I've got a carryover amount, so much better than previous tax years. The Iowa 4562 A and B, this form isn't new, and they're really, I don't believe this form has very many changes to it. One thing I want to point out on this form is I mentioned before, that our new system, it calculates tax liabilities down to the penny. I can't even say it, Kyle. My tongue's wearing out. But it rounds the tax liability down to the penny, and it makes sure that a lot of the numbers that are reported are correct. And on the Iowa 4562 A and B, this is the form where you're tracking some of your depreciation differences between federal and Iowa, like bonus depreciation. And columns E, F, G, and H, note that those amounts are supposed to be reporting the current amount of, I can column E, the current year Section 179 deduction, or F, the current year federal depreciation deduction. And then if we look at H, the current year Iowa Section 179, and I, current year Iowa deduction. Remember, those are current year amounts. So if in tax year 22, for federal purposes, asset A was eligible for a $10,000 Section 179 deduction. I'd report $10,000 in tax year 22, but in tax year 23, I'm not taking any Section 179, so that amount should be zero. It's not a cumulative figure, it's just a current year figure. And I just want to make sure you're aware of that and you review that before you submit returns. Otherwise, the system is going to make adjustments to it, or maybe make incorrect assumptions and adjust the amount of the depreciation deduction, and which of course would result in some correspondence going out. And I guess I'd prefer not to have any more correspondence going out than is necessary. Iowa tax credit schedule. Looks like we're getting down close to the end, but I want to keep on going. Some of this stuff is important. The Iowa 148, there's a lot of changes to that this year. The Iowa 148, that's where you report your Iowa tax credits, okay? And I want to make sure that you're aware that all tax credits are going to be validated up front this year. Someone made a note for me, want to make sure that you include all required tax credit schedules with your return, and those need to be completed by the individual. So complete all the associated tax credit schedules. Bullet point 2 was one that I wanted to make sure I threw out there. If you've got a pass-through entity, and the entity passes tax credits out to individuals, and you issue a K-1 for the individuals to report on their individual income tax return, make sure that that pass-through entity return has been submitted to the department, hopefully electronically, and processed by the department. Otherwise, if the K-1s are distributed to the shareholders or members and the return isn't filed, when they file their return, those tax credits are going to be disallowed if we don't see the path of where that came from. That's another thing that our new system can do. We can track tax credits more accurately. So make sure that you process, that you transmit the business tax return first before you send out those K-1s. Otherwise, it might result in more phone calls to you, more phone calls to me, and it'd be nice just to circumvent that altogether. In Senate File 2417, there were a number of provisions that were repealed. I got those listed here, and a lot of them are outdated, so they really don't impact a lot of people, but I thought I'd list them on the slides. One section related to the teacher expense deduction, but that was reinstated in House File 847, so we don't need to worry about that going away. They also repealed the qualified tuition expense deduction. That was a federal deduction, and we have our own tuition and fees credit, so we don't need to worry about anything there. Administrative expenses for fiduciary returns, those are no longer allowed unless they're allowed for federal purposes. Some of the things that don't go away, and you notice that on the Schedule 1 is the pension exclusion, the military pay and retirement exclusion, the first-time home buyer deduction, and then the adjustments for state tax-exempt bonds and federal securities exemptions. Oh, the set-off program. I don't want to miss that. There's a lot of exciting things. In November of 23, the state set-off program, that's going to move from the Department of Administrative Services to the Department of Revenues. And the set-off program, that allows the department to intercept some payments like the tax refunds, and we can use that to offset some of the debt that's owed to some other state agencies or municipalities or government agencies. Taxpayers are going to have an opportunity to challenge the amount that was subject to set off. And when we send out the notices, there's going to be instructions on how you can challenge those payments. Now, I was just looking at the next line. It said the pay may request for the division, or you can request for a division of the payment. And you can certainly do that. We've incorporated on GovConnect Iowa a form to be submitted for like injured spouses to request complete relief from some of the tax liabilities that are owed by one taxpayer or another. We've talked a little bit about the filing status requirement. Previously you could get around some of these set off issues by filing a married filing separate return, which you're not allowed to do anymore. But just be aware that we will be using the set off program to possibly seize some of the refunds to offset some of those liabilities, but we will have a vehicle for you to challenge any of the set off activity that we do on your behalf. GovConnect Iowa. And I know in the past we've encouraged businesses to set up a GovConnect Iowa account, which makes all the sense in the world, especially if you're paying sales tax and withholding tax. And we want to make sure that your power of attorney has access to any correspondence that goes out. But I highly encourage you or your clients to set up a GovConnect Iowa account for you if you have a business account, because the likelihood of having correspondence going out is a lot higher. So I would certainly encourage you to set up a GovConnect Iowa account. Again, you can get direct communications in here. You're going to receive some alerts from the department and the payment options. I think one of my next screens talks about some things that we're going to see with GovConnect Iowa. But in the past, you could use like e-file and pay to make payments to the Iowa Department of Revenue. Now in GovConnect Iowa, I can schedule future estimated tax payments, and I can track all those. And I think that's a big thing, because back when I was in practice, I gave out estimate vouchers to some of my clients, and then during tax season, I'd ask if they made the payments, and they'd bob their head up and down, and I sure did. But it wasn't until we got a notice from possibly the Iowa Department of Revenue or the Internal Revenue Service, we found out that they were late or the dollar amounts were changed. Now you've got an accurate record, or you will, once we get past rollout 3. So I encourage you to set up a GovConnect Iowa account, especially if you're associated with a business. Okay, here are some important dates for you to keep in mind. October 31st, that's the last day for you to review and download information from e-file and pay. So if you have clients that are making estimated tax payments in e-file and pay, or ones that are just making payments, you want to have a record of it, you've got to download those by October 31. Otherwise, they're going away. And the next date, November 1, they show it's gone. You're not going to have access to it. November 1st through November 12th, any payments that are made, you're going to have to use physical mail. The system is going to shut down because we need to prepare for the cutover into Impact. We've got, can't remember how many different systems we have. Everything is going to be pushed into Impact if they relate to individual income tax, fiduciary income tax, or estate income tax. On November 8th, 23, and I've got a webinar slide coming up in just a second, there's going to be a webinar that features some of the new and updated GovConnect Iowa features. Highly recommend that you attend that. On November 9th, GovConnect Iowa is going to be unavailable for system updates. And I guess that's when we're rolling through doing the updates. One, we're cutting off payments early so we can prepare those to be transferred in the new system. It's going to be shut down on the 9th, and then we plan on opening it back up again on the 13th. And then at that date, you can start scheduling some future payments in GovConnect Iowa. I think that, Kyle, I think that covers most of what I have. I'm not going to go through the common errors. I've got the slide deck here. I think I'm going to just jump ahead quick, and I think I've got some slides for upcoming webinars. There we are. That may be about all the tax that some of these people can handle right now. Here's some of the upcoming webinars. Again, on September 19th, Mike Mertens is going to talk about Iowa pass-through entity tax, the PTET. On October 11th, we'll talk about third-party access and authorization. On November 8th, that's the new and updated GovConnect features that I just talked about. And then December 13th, it's going to be an update on the submissions for W-2s and 1099s. If you've got clients or if you're required to submit W-2s and 1099s, I highly recommend that you attend that. Finally, I encourage you to subscribe to tax updates from the Department of Revenue. We got information on that slide. Otherwise, I think I'm at the end of it, Kyle. We made it.
Well, we how are you doing on time? Do you need to hop out of here like right at 2, or can you stick around for a couple more minutes?
No, I can hang out for a couple
Okay,
minutes.
cool. So maybe we'll stick around. We'll do questions for, I don't know, 7-8 minutes or so. Just complete transparency with everybody. There's about 165 questions right now that are open that we can possibly go through. And I'm sure as we're going through this, more will come through. Kurt, if you could just answer them as you go through. There's an answer live button next to the type.
Oh, okay.
You see that? Whenever you get to one that you're going to answer live, just click that button and submit it after you answer it, just so then we can keep track of it. Anything that Kurt isn't able to get to today, it basically is going to be sent to him, to his email, along with your contact info. So don't worry, he'll get it, and he'll get it in front of the right people to answer your question if he can't do it.
And I've already answered some, but I still need to click on some of those and still type an answer.
Yep,
even the ones I've answered already.
Yep, no problem at all. Just moving forward, if you could do that, that'll just be helpful.
Okay.
So,
I've got a question on here. Are draft 23 income tax forms available yet? And the short answer is the draft forms, we've made those available to the software developers. We have, I think, a few more that we're going to provide to them by the end of the week. I have been encouraging the release of draft copies of the forms prior to the end of the year. I think it would be helpful for you and for all tax preparers just to have access to the forms, especially the ones that have been modified substantially before the end of the year. So we are going to try to get those up on our site. We're going to have a new link on there that's just draft forms. Right now you can select by year, tax year 21, tax year 22, tax year 23, but yes. I can't see that I can type after I click the live thing. Do I just click done after I'm done?
Yep, just click done, and then it'll mark it as answered, and then we'll know moving forward that it was answered.
Okay.
Yep.
Yeah. On the next one, they're saying if our starting point is federal taxable income, will there be a line to make adjustments for the differences between federal and Iowa depreciation? And we talked about that. That's the 4562 A and B. We'll continue to complete that, and any changes will show up on that schedule, on that modification schedule. Got that one. Somebody's talking about and a potential issue if the plan administrators do refund the amount of state income tax that was withheld on a retirement account. And they're saying there might be situations where people have other income sources, like possibly like someone that has a cash rent arrangement. What I've been recommending to the plan administrators, and I certainly can't make them do anything. There's some plan administrators that want to send out letters to all plan participants and say, hey, if you want to stop withholding, fill out a new W-4P form. And I think that option is very trying, because then I would estimate 90-something% of all participants would have to fill out a new W-4P form, and all those forms would have to be sent back to the plan administrator. And I think that is much more burdensome than stating, hey, we plan on stopping withholding on this date, and we plan on refunding any Iowa income tax that was withheld as soon as possible. If you don't want that, notify us or complete a new W-4P, or however you want to work that. Then you've only got that 10, 5, 4% of the participants that want that withholding for some other purpose. So I understand where you're getting at, and I appreciate that question. Look, I'm going to see that one's answered live. There's a question on here. How's this work for military families? We used to use separate for Iowa for couples that have residencies of different states where some income is not taxable to Iowa as they're not residents. Then Rachel, we might need to talk about that. I'm not sure exactly what that question's getting at. And someone made a note that check the box on the federal return doesn't actually give any discussion privileges for the POA. And with ours, again, it's not full power of authority authorization. It really just provides them with the opportunity to submit information to the department. It's not like an open discussion. The department still won't release any confidential information to them, but it will open the door to receive additional information. I no longer have a P-10. I can't e-file returns even if I'm not receiving compensation. Prepare the return. Yeah, with the P-10 filing requirement, Iowa is the same as federal. Are you a paid preparer? If you're not a paid preparer, and you're only assisting somebody with preparing a tax return, I don't think that you would complete the paid preparer section. It would be inappropriate for you to if you are not being paid. But if you prepare 10 or more returns for compensation, like the federal return, you're required to complete the third-party preparer section, and you're required to complete a P-10. Otherwise, I don't think that you would. I see you, Kyle. Are we getting close?
Maybe just like 2 more.
Okay, I can do that. Then the next question: if the farmer who materially participated before renting the land passes away and leaves the land to his wife, can the wife exclude the rental income for Iowa purposes? Was the taxpayer eligible to make the election? I think is probably the important part of that. If a taxpayer passes away and they passed away prior to tax year 23, meaning they were never eligible to make the election, I don't believe the spouse would have any standing unless they were eligible on their own, meaning they could meet the ownership and material participation requirements. If the deceased taxpayer passed away after 23 and they would have qualified to make the election, then I do think the spouse could make an election and exclude like farm tenancy income. And I think we have a lot of that addressed in our rules. Can the sale of qualified stock apply to publicly held corporations? I don't think I see anything that says it's limited to a public or a private company. The important thing is that they had employees in the state of Iowa, that they met the shareholder requirement in Iowa. And a lot of times that does pull corporations into Iowa if you're required to have 5 shareholders in the state of Iowa, but there's nothing that says it has to be a public or a non-public corporation that I'm aware of.
All right. So with that, I think we'll wrap it up. Plenty of great questions, plenty of great content and everything. I'll just kind of wrap it up. I got a little ending spiel, and then everybody can get on with their day. So thank you again to Kurt for sharing the Iowa individual income tax updates for this year. As a reminder, this webinar was recorded and will be available to watch on our website or by searching Iowa SourceLink on YouTube. That link has been put in the chat a couple of times, so you should be able to get that. If your questions were not answered today, make sure to download the PDF versions of the slides, as your answers may be found there, or you can rewatch this webinar for clarification. Your questions are also going to be emailed to Kurt alongside your contact information, so he can follow up with you or anybody else who can assist you will. As a reminder, Iowa SourceLink does not provide continuing education certificates for your attendance here today. We do, however, send out an email to all those who participated within 24 to 48 hours, just kind of depends, after this webinar concludes, that you can use for proof of attendance, but this is not some sort of formal certificate. So just keep that in mind. The next Iowa Department of Revenue webinar will actually be next Tuesday, September 19th, to provide an overview of Iowa's new elective pass-through entity tax that applies retroactively to tax years beginning on or after January 1st of 2022. So if either you or someone you know would be interested in attending, make sure you sign up on our website and have fun with that. We'll get to hang out next week. If you decide to join, you'll get to hang out with me again, and hopefully you aren't driven insane this time around. So until next time, everyone, take care. And thanks again, Kurt, for sharing some awesome info with us today.
All right. Thanks, Kyle.
Yep. Goodbye, everyone.